All right, today we're going to look at transaction analysis. We're going to do this in the format of the accounting equation. First, let's assume the owner invests $50,000 cash in the business. Let's think about what accounts would be affected. If the owner's investing cash, then cash account would have to change, and if the owner is going to receive common stock for that investment, the common stock account, which is part of owner's equity, that would also have to change. And in this case, the increase in cash is $50,000, and the increase in common stock is $50,000. What if instead the owner didn't invest cash, but invested $10,000 of equipment? Then, under the assets, equipment would have to change, and under owner's equity, common stock would have to change, and now it would be for an increase of $10,000 in each case. What if the owner purchased equipment but didn't pay for it with cash? The equipment was purchased on account. Then under the assets we would see equipment, and under liability we would see accounts payable. We have more equipment and more liability, so an increase of $12,000 on both sides of the equal sign in order for the accounting equation to remain in balance. What if the company paid $1,600 for rent? Rent occurs each month, and it does not have benefit into future accounting periods. So rent is not an asset. Rent is actually part of the expenses. And all expenses have a decreasing effect on owner's equity, so they always have a negative aspect to the value of the business. So when we pay for rent, we have a decrease in cash, and we have more rent expense, more of this negative effect on owner's equity. Whenever we see the word paid, we can understand that to mean that the cash account is going down. So paid means a minus to cash. What if we performed services and the clients paid us right away for $2,000? So we've got more cash, and now we've got revenue. We might call this fees earned. And in this case, the clients are giving us the cash right up front, so we have more revenue. We've provided a good or a service, so increase in our revenue, increase to cash. Sometimes, though, we do the work and we don't get paid right away. How would this affect the accounting equation? Let's assume we performed services on account. So we've done the work, but we have not been paid for it yet. Instead of cash, we have the asset accounts receivable, and under revenues, again, we still have fees earned, and in this case, the value is $7,000. So sometimes we receive the cash, sometimes we perform the services on account. What if we paid $8,000 to purchase equipment? What accounts would be affected? When we see or hear the word paid, we know cash has to be affected. And in this case, we're purchasing equipment for cash, let's say for $8,000. That would mean cash has to go down by $8,000 and equipment should be going up by $8,000. Notice the plus and the minus are both on the asset side of the equation, so the equation is remaining in balance. Sometimes we have to pay our staff assistant for their labor services. What two accounts would be affected? Cash, because we're saying the word paid, but the other side of this, it's not an asset because we don't own our staff people, but they provide a service for us. We are using a resource. That's the definition of an expense. So when we pay for our staff assistants' labor services, we have wages or salary expense, and we see decrease to cash and more wage expense, more of this negative effect known as an expense, decreasing the value of owner's equity. Now earlier we did some work on account, right? We did work for our clients and they didn't pay us yet, so it created an accounts receivable. When the clients decide to pay us, we'll see that cash is affected and accounts receivable. So the asset accounts receivable is going to go down and we're going to see an increase to cash. So transferring one kind of asset account for another. Similarly, Earlier, we made a purchase of equipment on account. Now, if we pay part of that balance, this is sort of like paying part of your Visa balance, we would see the cash account being affected and the liability account being affected. And when we pay, cash has to go down, and the account balance, accounts payable, also should be going down. What about when the owners receive a return on their investment? The way a company distributes prior profits to the owners is through the payment of dividends. Dividends have a negative effect on owners' equity. They're not an expense, they're their own category. And so when the company is returning prior profits to the owners, we see a decrease of the company's cash and $500 more dividends, more of this negative effect on owners' equity. This is a pretty comprehensive list of sample transactions. I hope this helps. Have a great day.